Welcome back to the show. So in today's video, I'll be talking about 3 stocks that are on my watch list today. So in today's video, I'll be covering a few things. We'll be covering the stocks that are on my watch list, United Health update, as well as some questions that you guys have left me in the comment section below. So regarding the stocks that I want to own, these are the types of stocks that I want to own. I want to own high quality compounding machines with strong moats, strong fundamentals, decent management, and a differentiating product as well, because a good product will help to bring this company to a much wider scale as compared to a company that is only able to do good marketing. So the first stock that I would like to own is Alibaba. So Alibaba over here is a company that is currently now trading at around a 16 times earnings over here, and year to date it's up around 40% already. So it is by no means a stock that is distressed right now. It is a company that has gone up quite massively this year already. So for Alibaba over here, this is their business segment. So they have their retail side, which is their Taobao, Tmall, their Alibaba International Digital Commerce Group. They have their cloud, which is the fastest growing segment right now. They have their logistics firm, which is their Cainiao. They have their digital media and entertainment group, which is their Youku, their Dama, and all these portions over here, and everything else is lumped under here. So the fastest growing segment is of course the cloud segment, and then you have the recovery of your retail segment as well as your international digital commerce group. So for Alibaba over here, if you have to look into their recent earnings itself, I think the recent earnings were quite eye-opening for me. It was quite decent from this company. So the Taobao and Tmall group retail portion went up 12% year on year in terms of revenue, and then the total Tmall group went up by around 10% or so. The Alibaba cloud portions went up 18%. So we are seeing sort of like a re-acceleration in growth in terms of cloud in China. And for China over here, there is a total addressable market that is very large, that is still untapped right now. And then they have the international portion as well, which is growing at around 24%. So overall for Alibaba over here, although the top line is growing only at 7%, it is largely due to this Cainiao portion, which is the portion where they're losing money. But overall, the business fundamentals are still growing quite well in terms of all your different other segments. If they can slowly reduce the loss that they are having on this logistic firm over here, then they will likely earn returns that are great over time. So for Alibaba over here, this is the cloud market share in China. So they are the largest cloud provider in China, and the second largest is actually Tencent. So Tencent is this portion over here, and Alibaba holds around 39% of the total cloud market share in China itself. And for the China cloud computing market size over here, it is projected to grow around 24% CAGR all the way until 2030. So we're currently now in 2024, and we have another 24% to go for every single year all the way until 2030. And this will be a massive tailwind for Alibaba because they have around 10% of their current revenues coming from their cloud service. So increased AI adoption in China, which is already larger than the US itself, could be a tailwind to drive this cloud computing growth over here. And Alibaba will definitely be one of the beneficiaries of it. So for the Chinese consumer over here, this is the China consumer data. And as you can see, the China consumer data has weakened over the past few years. We've never been this low over the past 10 years or so. And so the China consumer data is still weak, but a reversion to a mean will lead to a lot more growth for Alibaba over here. So in the recent months or so, we're seeing sort of like a growth in consumer spending and retail sales as well in China, because the government is basically trying to pump in stimulus to basically boost spending over here. And Alibaba will benefit from it. So for Alibaba stock over here, I'll be looking to enter in the hundreds. Their recent earnings report surprised me with a reacceleration in both their retail and cloud segments. Their retail segment is unbreakable in China and Asia and will probably continue to print them money as long as the consumers continue to spend. So overall, I think Alibaba is a high quality business in China itself, and there's no one that is able to take away market share from Alibaba in the China retail portion over here. And that's why I think Alibaba is still looking like a decent stock despite it being up around 40% this year already. It's still currently trading at a 16 times earnings, still relatively cheap relative to its historical mean. But of course, last year we saw what happened with Chinese stocks. They were decimated. Alibaba last year was trading at around 11 times earnings. So we could go down there as well. So for Alibaba over here, I'm looking to add at around $100. That'll be the price that I'll be comfortable adding in around a 2 to 3% position size for Alibaba over here. The next stock that I'm interested in as well is Fair Isaac, so FICO. FICO over here is a company that is trading at 94 times earnings, and year to date it's up around 10% already. At one point it was down around 16% year to date, and now it has recovered all of those gains. It's near all-time highs again. So for FICO over here, this is their core business. What they do is they sell credit ratings for consumers. So for example, let's say a consumer, they want a loan for a car for maybe around 200K or so. they have to pay a FICO score in order to get a rating so that they can basically go and borrow money. And the FICO scores over here can literally 2x and the consumer will still pay, because the relative comparison of your FICO score as compared to the mortgage itself is so wide that the consumers won't even bother about paying double of what their FICO score is currently. So this is the FICO score price hikes. FICO is going to increase the prices from $3.50 to $4.95 over here. And that's a 41% increase in prices in percentage terms. So they can hold their volume stable and they can increase prices by 41%. That will lead to a 41% increase in their revenues over here, which is just incredible from this business. So if you listen to what Chris Hon said as well, there are two main drivers for revenue growth. One of it is volume growth, the other one is pricing power. So for the majority of the companies in the S&P 500, the only way that they grow is through volume growth. But for a company like FICO, for example, which is able to increase prices, they will also grow through price increases as well. And the price increase will cause the profits to grow a lot more than the revenue itself, because every incremental dollar is just simply a profit for this company. And so for FICO over here, I think it's just an incredible business. It's extremely high quality. It is a monopolistic business, and that's why I would like to own this company over here. So for FICO over here, despite the volumes dropping over time, so over the past 2 years or so, the volumes have been dropping simply because of the high interest rate environment. We've seen a 25% net income growth for FICO over here. So this is their latest report over here. They reported 152.5 million in the Q1 of this year as compared to 121 million in Q1 of last year. So that's around a 25% net income growth over here, despite the volumes dropping. So they can offset the volumes dropping by just increasing the prices. So it's just an incredible business that I would like to own over here. And for FICO, my concerns with FICO is simply just regulations as well as the valuation itself. So regulations could come in and basically stop this company over here, because the company is relying so much on price increases, and this could harm the consumers in the eyes of the regulators. The valuation of the stock is incredibly rich right now, probably not an ad at anywhere near this price. So my ad price will be around $1,300 a share. That will be where I'm comfortable adding. Third stock is PoolCorp over here. So PoolCorp year to date is down around 3%. It is a company that is currently now trading at 30 times earnings, around a 1.5% dividend yield over here. So Warren Buffett has been buying PoolCorp every single quarter ever since I think 3 quarters ago. He's been adding steadily into his position over here. So for PoolCorp over here, this is their business model. What they do is they basically sell everything related to the pools. They are a B2B business over here. So the categories are as such. They have 65% of their revenues coming in from maintenance, 20% coming in from pool upgrades, and 15% is related to new pool construction over here. So for PoolCorp, 65% of their revenue is actually non-discretionary, because it includes stuff like your chemicals, your pumps, your cleaners and all that, which are all non-discretionary. It's all maintenance. And then the remaining 35% is more discretionary. So for PoolCorp over here, here are some of the tailwinds for the business. So number one is just the increasing installed base. So the pools, they typically last around 20 to 30 years, which is 20 to 30 years of revenue for PoolCorp over here. And as more people build pools and as more people basically spend money on pools, this will lead to a larger installed base and it leads to more revenue for PoolCorp as well. Then the other tailwind is simply just the industry as a whole. So the industry is projected to grow around a 4.4% CAGR over the next few years or so. And PoolCorp, being the monopoly in this business, will likely grow a lot faster than this 4.4%. So you could see this company growing at 8-9% or so, returning back to its historical averages over here. So for PoolCorp over here, here are some of my concerns with this stock. Number one is simply just the valuation itself. The valuation right now is currently a bit too high. It is currently trading at around a 30 times earnings. The company is facing a pullback in earnings. They over-earned post-COVID because of all the stimulus money, and it will take time for the pool industry to recover from high interest rates as well as low housing activity in the US over here. So for interest rates over here, the interest rates are set to go lower in the US itself, barring any other macro events. So when interest rates drop, this leads to more people buying pools. This leads to more people basically setting up homes as well. And this will lead to overall increased constructions of all your different pools over here, increasing the revenue for PoolCorp. And this is a tailwind that is being priced into the stock right now. Currently for me, I think for PoolCorp, it is a decent business that Warren Buffett clearly loves, or at least one of his understudies. The stock is likely to re-accelerate growth after it returns back to its mean, and I'll be comfortable adding this stock at around a 20 times earnings. Currently now it's trading at a 30 times earnings, so I either need the earnings to basically re-accelerate for me to basically buy into this stock, or this stock will have to fall a 33% for me to add into this one. I think overall PoolCorp is a decent business. It is not one of the highest quality ones out there, and that's why I think around the 20 to 25 times earnings should be okay for this company. but certainly not a 30 times earnings, which is what Warren Buffett has been adding at. So next portion over here, I'll be talking about United Healthcare stock. So United Health today is up around 7%. And at one point last week, it was trading below a $250 a share. So for United Health over here, it is still currently trading at a relatively cheap valuation, around a 13 times earnings and around a 2.7% dividend yield over here. So for United Health, in the past few days or so, we've seen a lot of insider buys. So the CEO, for example, he just bought around a $25 million worth of United Health shares over here. And you're seeing all the different directors basically buying up United Health shares as well. So for insiders, they normally sell for a lot of reasons, but they only buy for one reason, and that reason is that they're simply just bullish on the stock over here. So for Hemsley over here, he has around $300 million worth of United Health shares over here, and him bumping it up by 25 million just shows that he is confident on the recovery of this stock. So the moral of the story for United Health over here over the past few days or so is to not let your emotions get to you. When a company as big as United Health is down 50% from before earnings itself, then it smells like opportunity. Last portion over here, I'll be talking about some questions that you guys have left me in the comment section below. So the first question over here says, "Hi Guan, what are your thoughts on CAT?" So for Caterpillar over here, it is a company that basically sells all your different industrial products over here. So they sell the cranes and all that, which are required for construction. And for Caterpillar over here, I think the biggest competitor, if I'm not wrong, is John Deere. So for Caterpillar and John Deere over here, the problem with these two businesses is they are cyclical. Because all your construction materials, they are only required when there's more house being built. But for Caterpillar over here, I think the fundamentals are quite solid. If you're to look at the fundamentals itself, as well as the valuation right now, it is currently now trading at around 16 to 18 times earnings. And the fundamentals over the past few years or so has been quite remarkable for this business. So for this business over here, although I don't think investing in industrials is generally the approach that you want to take and the sector that you want to invest in, I don't think Caterpillar is a bad stock, and I certainly will be looking at this one in the near future as well. Next one is Nvidia worth holding. So for me, the problem with Nvidia is this: it is too AI tight. So the company has grown because of the entire AI crowd, and the only story going for it right now is simply just the AI growth. And then you have competition coming into this space as well. So although they have the CUDA software ecosystem over here, for the chips that Nvidia are making, there are other TPO alternatives that are coming up as well. So you have Google coming out with their own chips, Amazon, Microsoft, all doing so as well. And then you have AMD, which is only 1 year behind Nvidia over here. So for Nvidia, it is simply just too tight and too concentrated in one sector, which is your data center revenue. And so for me, I'm not sure what Nvidia's true moat is, and so I won't be investing into this one. You can hold on to your stake, and I'm sure it has performed well for you over the past few months, the past few years or so. And for me, I'm not investing in this one. I'm not planning to. I think the better semiconductor bet is just to buy ASML or TSMC. They are less tied to Nvidia as a whole. Last comment over here, it says, Google isn't the only company being investigated by the DOJ. They will get through this. Search isn't their largest revenue. And also, they may be saving around $20 billion if they don't pay Apple. I'm bullish on Google at current valuations. So I'm bullish on Google as well. But a few things. Search is their largest revenue stream. So search makes up around 50% of their total revenue. And it is a business that could be decelerating and declining over the next few years. And if you're to look at all the super investors, a lot of them, the ones that I respect, they've been selling out of their Google positions over here. Next portion over here, they'll be saving $20 billion. So yes, they'll be saving $20 billion, but the problem with that is they won't be able to reach as many users as what they're currently doing right now. And so although in the short term, consumer behaviors won't change, in the long term, if you're to remove all these different Google search engines on Apple devices, consumers could start pivoting away to other search engines over here and even potentially ChatGPT and all your different LLMs over here as well. And so although Google is a company that is quite undervalued right now, I have my fair value of Google at around $190 a share. I think it is a company that is currently facing uncertainty, and that uncertainty could certainly basically evolve into risk for this company as well. So currently now, I'm not adding to my position. I think I'll be holding on to this one and maybe trim it at fair value or so. And unless Google can innovate, this company could be on a decline over the next few years or so as LLMs, they become exponentially better. I hope you guys have found this one useful and invest safe.